Right, welcome to today's webinar. It's our weekly Outlook webinar, and it's the 22nd of May. So we had a bit of a wobble in stock markets last week. It was a bit interesting, but we've bounced back since. So we're obviously going to study some of those charts for the major indices, particularly those US ones like the Wall Street chart traded with LCG, just to see if there's any chance this little correction from last week has any legs. Obviously the DAX and the FTSE as well. A couple of big events to discuss this week. I'm going to switch pages now. I'm going to assume that you've all looked at this risk warning on the screen here. So big themes very much as they have been. Which of those themes are we focusing on this week? Well, under the this week category, you may have read earlier today that the UK threatened to quit the Brexit talks over this €100 billion. I haven't written it there, but that's the exit fee that the Eurozone are looking for. So obviously that would be a massive amount of money for the UK to have to cough up to the Eurozone. As an example, the Chartered Institute of Accountants said it should be about 5 billion, so 100 billion obviously pretty crazy. So there's estimates all over the place. Jean-Claude Juncker, he said it should be about 50 billion. The Financial Times had mentioned 100 billion, so that's where that figure comes from. And so obviously we're seeing a little bit of pound weakness today because of that. Not a dramatic amount, but obviously we're still trying to overcome that 130 level in cable, which we'll also look at on the charts. The reason there's been a bit of a euro breakout today is that Merkel blamed the ECB for the euro being too weak. So obviously the Chancellor of Germany calling the euro too weak. We're seeing, the euro go up because that would sort of imply she would prefer a stronger euro, and maybe she would actually implement some sort of policies which would be pro-Europe. Her excuse in the past is that, well, the ECB is independent, so she can't do much to control the currency. That is and isn't true. Obviously, the European governments set what the mandates are for the ECB, so they could change the mandate of the ECB. If they engaged in some sort of fiscal stimulus in Germany, which a lot of people are calling them to do, Germany should do a lot more. Germany are really benefiting, getting a massive trade surplus, which we saw in data today from a weak euro, whereas other European countries are sort of suffering because they can't compete as well as Germany when they're all trading on the same currency. Obviously, historically, all these other countries had a cheaper currency, so it made their exports more competitive with Germany, or at least as competitive. So the argument is that, okay, if you want a common European area, well, Germany needs to spend some of that money they're making from those exports on the rest of Europe. So obviously that's a complicated question. So there is things Germany could do, though. So hence the euro popping higher, but as we're going to look at the charts in a minute, the euro is basically in a big breakout right now, and it's a decent breakout and trend higher. So it's something we want to try and participate in, and this is just another little news item which is catalyzing this up move. Big events this week are the Fed minutes and particularly the OPEC meeting. We had a bit of a crash in the oil price and subsequent rebound, so we've taken out about $54 a barrel in Brent now. So we'll have a look at those charts. My take is that we pretty much know at this point that, and I mentioned this in the week ahead video, we pretty much know that OPEC are going to extend the cuts at this point, probably by 9 months, because that's what Saudi Arabia and Russia are saying. So that's almost baked in, but the oil price hasn't fully recovered the losses. I think it will get a little pop probably when they actually do announce it, but I'm not sure if we can really get above that 60 handle again. So we'll have to, so that's an idea that maybe the market considers these cuts not enough. So we just have to watch the price action on the charts if we do get a push towards those highs of the year again in Brent and US crude. In terms of economic data, not much going on. Obviously, we've got the Fed minutes, as I mentioned. The main thing there will be, obviously, they didn't change interest rates at the last meeting. So the main thing will be, did they discuss shrinking the balance sheet anymore? And obviously Trump was kind of blamed for the wobble last week. obviously there was a bit of scandal in Washington, but I think Trump is probably getting a bit too much credit for the move higher in stocks, and he's probably getting unfairly criticised for the move down. I don't think it's all relating to Trump, but nonetheless, I think at the very least this foreign tour of the Middle East and Israel and a bit of Europe as well will actually distract a bit from the troubles with the policies at home. So, moving swiftly on to the trading platform. Forgot to say that, just please send through any questions. I see a few questions coming through already, so that's great. And I'll keep trying to check those questions, and obviously, I'll try and just address them as we go. Always trying to. So. I know Colin was saying that everything. Are you saying everything's all right there, Colin? Obviously, yeah. Let me know if you're not hearing anything or seeing anything at this point. You definitely should be. Okay. So we've got the. Let's just start with the euro, because as we mentioned, we're getting a little breakout today. So this is a daily chart, obviously, and these were the highs of last week, and we've obviously a little false break to the downside. A lot of people actually use this as a part of their strategy, because what you'll often see is the market break in the wrong direction initially, early in sort of Asian trading hours, and these Asian trading breakouts often tend to be false breaks, and then eventually, particularly when it's a false break, a breakout in the direction against a very strong trend, they're basically kind of sending the market lower in thin trading, basically running a bunch of not stop losses but orders in the market. Obviously people selling on the breakout, people selling, and then the big buyers come in and buy and push the market up in the direction really it should be going, which is to the top side. So that's a bit of a kind of classic formation here. Just see it in one bar on the daily chart. You can see it a bit more simply if we got a bit more granular detail. Here were the highs of last week. Obviously we kind of just dropped into a kind of trading zone where we had a couple of highs, tested the lows a few times. Here was the Asian break, and then here's the rebound, well within sort of uptrend territory. Trying to draw a trend line to demonstrate the point, but failing to do so. But you can see that basically, even though we took out these short-term highs, we're well above the kind of daily point that you would categorize a serious breakdown from being, the old days lows down here, etc. So here we are. And what's the greater scheme of things here on the euro? Well, good to have a look at a weekly chart. This was really when the game changed down here, and we've talked about this lots of times. We held above these historic lows. We basically held the bottom of this trading range, and then there was a few highs in here. We broke to the top side, held it on a retest, and now we're getting the big breakout. And to me, I think, like, given the extent of this breakout, obviously you might get a little bit of a pause around the 113 mark, because that's where we had that dramatic turnaround. I believe that is that November? Yeah, that was the US election. So there might be a bit of a stumbling block there, but really I think for me the proper line in the sand for this market is just shy of 115, but I like this sort of 114.50 kind of area, because that was that initial rebound from the lows here, and that was kind of a false break. It held nicely there, false break, held nicely there, false break, didn't quite reach it there, and then we haven't quite made it back since. So if we are going to eventually turn lower in the euro, which is entirely feasible, I think we really need to re-challenge the 115 level before that can happen. And it looks like that's what's going on at the moment. We're getting a breakout to the top side, and we're going to challenge the top of the trading range. And again, looking on this weekly chart, if you do use indicators, you can sort of see that the trend has definitely changed here. There's the bounce, there's the retest, here's the move higher. We're making higher highs and momentum, and down here you can see that the MACD histogram has shifted positive. So obviously a prolonged time in the negative, but as we popped above the 50-week moving average, that was about the same time that the MACD turned positive too, telling us that we're in a sort of generally positive area of the market. Now obviously once we get a kind of situation like this where we're in positive but then the market starts rolling over, that's when we can get corrections, but still while in the positive territory on the MACD there, tells us actually we could be moving into more a trending period than a range bound. So that'll be the next test for me, 115, and that's when we could get a serious explosive move to the top side, but we're not quite there yet. Oh, in terms of indicators we got on the chart, so I should say that there was a few requests to have the screen in white. So now I'm hearing a couple of people saying they can't see the indicators on white. So I don't know, I'm going to have to find like a grey here that's in between black and white that satisfies everybody. But I'm hoping most people can see this indicator here. This first one I typically use as my momentum indicator is the RSI. Green is the default color, but you can change the colors around a bit. So if it's a let's go for a darker color. Let's go for that. Is that more visible? It's a darker green. And then in a trending market, sometimes I'll use the MACD as a little backup as well, because really, even though it's an oscillator, it's best at kind of telling you the trend rather than overbought and oversold areas. RSI can sort of do both. Obviously above 70, overbought, below 30, oversold. But also shows you the divergences at areas of extremities and can kind of confirm and deny the trend as well, as we previously showed. So this is cable. Obviously the big line in the sand here is the 130 mark, and that's why I've just kind of, these few highs here were just a few pips short of 130. There's 130 there basically. We're sitting on it at the moment. So the market finished last week positively. So this is the general, it's a very similar looking outlook to the euro, but just on a kind of shorter term basis, if you like. The basing period has obviously been a lot shorter period of time than the euro. But here is our sideways zone. We weren't able to push into lower lows through the Brexit lows of around 118, and we've taken out this down sloping trend line, and we're pushing above the weekly moving average. And it looks like the 20-week moving average is turning up. So at the moment the market's looking quite positive, but Fibonacci wise we're sitting right between the 61.8 and the 76.2. The 61.8 is held as support. The week before last we had a little dip. Last week we pretty much unwound all those losses but weren't able to push beyond them. So it's a little consolidation that's happening beneath 130 at the moment. So unfortunately I don't have a crystal ball. I don't know if it's going to break above it, but I would suggest that probabilities dictate it's probably going to go with the trend, and the trend is up at the moment. We're above those moving averages, we're breaking out of a range, and that to me would suggest a move beyond 130 and up to challenge 135. But of course we may not get above 130 in the meantime. We may need a push lower down through this consolidation area to pick up more buyers again if the interest isn't there. The longer we consolidate, the bigger risk that it's a down move rather than an up move. Typically continuation patterns are shorter in nature than kind of top and bottoming patterns. So the longer we start fluctuating around here, the bigger the chance is that it's a short-term top and needs a move lower. If there is a move lower, where do we look for the bounce? I've got a downsloping trend line here, but for quite a while I had a horizontal line, and I would say where we had that first bump, it's in around there. That's the kind of big former resistance turn support, which is about 126.70. So if we do break down through the bottom of this range, if you're a bit of aggressive short-term trader, you could maybe target the 126.70 on the downside. If you're a bit more conservative, believe this up move is sustainable, you'd be looking for that area of support. So generally good to look on this big weekly picture to get a feeling as to what the chances are of the daily moves continuing. At the moment, we're kind of chopping around on 130. To my mind, that good weekly finish up here above 130 suggests we're going to get a continuation to the top side, but we haven't got it yet. Obviously, a bit of negative news today. So, if one thing you could look at it here is what has the pound reaction been to what's quite negative news about ending EU Brexit negotiations? Well, it's been quite a small move down, so you could say that actually it's relatively quite a positive reaction from the pound versus some quite bad news, which would lend support to it moving to the top side. Okay, so moving on to dollar yen, this is one where actually I want to zoom. This is the daily chart, and obviously there's just not really a trend right now in dollar yen. We had a nice move to the top side. We unwound a lot of it very quickly. So what's generally going on here? I actually think it's worth looking at the monthly chart here. We had the big move down lower from the highs. We found support here at pretty much the kind of 100 level. 170 was what supported us back here, but just through here it was basically 100. We flew higher above the moving average, and we've been correcting this big upwards move, and it was these, when we were in this trading range up here, is these lows, the supports, that have turned into, broadly speaking, the resistance that have caused this correction. So we had a nice kind of doji looking hammer pattern on the weekly chart, suggesting that we could have had more upside, but that upside's been quickly reversed. If we go down to the weekly chart, we can see last week obviously was quite a big slide lower. So the week before last was a decent bullish pattern on the weekly chart. So based on a weekly chart basis, this move lower on the monthly chart, so on the weekly chart, perhaps is taking us into an area of value for the up move to continue. But there really isn't a particularly solid trend. It's not entirely clear what the outlook is here. You could argue that this is a strong up move and that this is a more choppier correction, and we're just looking for the choppy correction to end for the next surge to the top side. Or you could argue that actually this was just a bear market rally, and this is the beginning of the bear market. That bear market rally, which tends to be stronger, is over, and we're gradually getting ourselves to a point where we're going to roll over again. It's really not too clear which is which. So at the moment, actually these swing points are working quite well on on both bullish and bearish side, just because there is no obvious market direction. To my mind, if we get this as a pattern in itself, we have a little bullish move, two bearish moves in the middle, and then if we get a close above those highs here, that would be a nice little continuation pattern, reversal bottom pattern, to suggest that actually we can push up to the lows here. And then once we get to there, that's when we're looking reversals again to the downside. So it's going to these support and resistance areas that have worked and looking for the reversals at that point. Here's the UK 100 moving over to indices. Obviously we made the record highs up here, but this was a kind of bearish topping pattern. We saw a big drop down, but the old resistance worked quite well as support. We bounced straight back. I thought maybe that we'd get a bit more off this, but that was it actually ended up being, from a very negative week, ended up being vaguely positive, and hence the last couple of days we've been pushing again to the top side. It's obviously the 7,500 level that we're trying to break through. Bigger picture, even bigger picture than that. What we're kind of looking at here is potentially a really significant, I know this is a bit of a crazy chart to be looking at. We don't always look at monthly charts, but there's just, particularly when it comes to equities at the moment, there's potentially a really massive breakout taking place in the FTSE here, like I always get the numbers wrong when I'm quoting years, but this was back in 2000. So we're looking at a 17-year breakout here in the FTSE. Now obviously we don't know if it's going to be sustainable or not, but pretty much this sort of 7,000 level, 6,900, was resistance for a long time, and we've taken it out. And obviously the way the pound moves is going to affect the FTSE day to day, but the pound is probably going to remain much weaker than it historically has been. That's a good thing for UK companies, particularly the multinationals listed on the FTSE. Generally the environment's pretty good. So as much as we kind of worry about Brexit and its outlook, earnings get a significant boost from the lower pound, and to me that makes sense for why we're getting this big breakout in the FTSE, and this big long-term outlook gives me confidence in the move to the top side. But obviously it's going to be choppy along the way. When you drop down to the shorter term charts, you're going to get the corrections, but I'm viewing those as more opportunities, and we saw that in a big way when we got the big drop down to the support here that we highlighted in one of the previous week's webinars. And it's worked again here. Just a very interim level of resistance is worked nicely as the support, and we're back at the record highs again. So this was I've kept this little line on here on the Wall Street chart just because I thought it was an interesting example, because we had the big push higher, we had a bit of a correction, but we were looking for opportunities for the trend continue to the top side. We had a nice break here, and then we had this candle here was really the warning candle, where we had a nice bullish engulfing candle here after a correction, after touching the previous low. That should have taken us out into new highs, but we had this indecision doji candlestick, and it was literally the next day where the market just fell off a cliff. So that was the warning point for me. And then if you were long on this breakout here, obviously you just cut your losses somewhere down in and amongst these lows, and the market just dropped right down. Now we're back to that same area again. So at the moment, as of Friday, there wasn't much evidence of a pullback there. It looks like we're going to get above this line again. But I'd even see maybe this line, because it fits in with the moving averages, is perhaps another area where the market could roll over. I probably still wouldn't take it though, just because the bias in the stock markets at the moment is so much to the top side. It's really better looking for buying the dips than it is trying to call the top of the market. But this is the first area we'll have to overcome should this move not continue again to the downside. The DAX actually has a bit of a opposite pattern to what I was mentioning before, where we had the big bearish move to the downside, couple of tiny, almost pretty much tiny inside days, and then what could be another bearish day today. It's not very bearish at the moment, but if we did close below those lows, or even just break intraday down those lows, you could get another move like this down into maybe just below the 50-day moving average. That would seem quite reasonable, because it was a steady uptrend. Suddenly momentum burst out beyond what had been containing the momentum, and it would make sense that then actually we push down to the bottomer regions of the mean, which is this kind of value area between the moving averages. I see someone asking, can we revisit the webinar as a recording? Yes, it's being recorded, so I'll put this on typically in a couple of hours or so on YouTube, and I'll tweet the link out. So moving over to the oil market, obviously, this was the big sell-off. We mentioned in the previous couple of weeks ago webinar, there was this rising trend line that could have worked, and as it turns out, it's worked out pretty nicely. We're right back in the vicinity of the 20-week moving average now. As I said, these were the losses. We haven't quite made them up yet, so we'll have to see what the reaction is post the OPEC meeting. But again, we kind of know the result of the OPEC meeting, and hence the market's been so strong, but that doesn't mean that it has to roll over straight away. We can still get another positive reaction, but I suspect the risk is that maybe it's just kind of blow off top after we get the news, and might be harder to make further gains in the days after. So it was a very bearish market, but obviously we're reversing a lot to the top side here. The next, this 61.8 retracement and these previous peaks was a big level to overcome. We have overcome it. So given the size of the drop, there isn't really too much in the way of resistance. So only really the 76.4 fib, which can stop us, but there's not much history behind it. Other than, you could argue, the triangle pattern that we broke down from, which was kind of this one. If you're actually drawing a trend line through the lows, that kind of lines up quite well with the 76 point in the kind of area that we're at. So we're at the we're at the 76.4, we're at the 20-week moving average, and we're at what was a resistance and then turned into support during a consolidation. Potentially this kind of area could cause the market trouble. I don't really see how it would. I'm not sure what OPEC could announce that would be disappointing. It's going to be a pretty straightforward extension of the cuts they've already agreed. There's a possibility they even surprise on the upside and cut more than they previously announced. But we'll find out on Thursday. Gold. This probably, given the various factors affecting currency markets at the moment, the kind of less European political risk going on, etc., the UK election, currency markets being a bit more coloured by what's happening in Europe, and the sort of safe haven play going in and out of the yen. Gold has actually become one of the better areas, in my view, to actually play directly what the Fed are doing. So obviously if they're hawkish, that's typically negative for gold, dovish otherwise. We mentioned this 1260 level in the previous week's webinar. We've got to move straight up to there and a nice pop down into the confluence of moving averages, and we mentioned it on the week ahead video. It's going to be a big one for the week ahead. If we get through there, to my mind, not really much stopping us trying to run up to 1300 again. This is the kind of big level. The market could roll over from here back down to the trend line pretty sharpish if the Fed are overly bullish. What are we looking for the Fed to say? Well, obviously they didn't change interest rate policy. The market's expecting a June rate hike. The Q1 data was weak, but there seems to be a bit of a turnaround in Q2 so far in terms of US data, and the Fed have already described Q1 as transitory. So really they should still be, the chatter from the meeting should still indicate that they're on for June. So then it depends what they say about shrinking the balance sheet. The risk would be that maybe they get a bit too aggressive about when they're going to start shrinking the balance sheet. That might mean less rate hikes this year as they concentrate on just shrinking their massive balance sheet. That would be a dollar negative situation and a gold positive, and see us take out this 1260. So there's a few other markets we could look at, but I think we're running a little bit over here, so I'm going to call it a day at this point. Thank you very much all for attending. I hope that was useful, and see you again same time next Monday. Jasper signing out.